In today's video, I'm going to be going over a lot of economic and AI data points and how they can inform your investment decisions and frame your thinking about this AI investment cycle. We know AI will fundamentally change the way business is done, but will the return on investment happen in time for the market to be satisfied with the large Capex spend? We're going to be answering that later in the video. We generally view companies on an individual or joint evaluation basis, but it's a good idea to also take a step back and look at the macro environment that is inevitably linked to the AI Capex spend, which is affecting the broader levels of equity valuations, to see if this could have any effect on the businesses you're invested in. Looking at the broad macroeconomic data as well as the rate at which AI is making its way through the economy is important because it affects all segments of the market. This data goes over how the AI technological revolution is affecting companies based on their timing and level of adoption of AI and how this compares to past technological advancements. I think that this data is really informative for shaping your thoughts on investing in AI as a whole and structuring how to think about AI's integration throughout the economy. Lastly, I'm going to go over what I'm doing with my portfolio in light of some of this data. I've recently made some bigger moves in my portfolio and want to go over why I decided to make those decisions. So let's get straight into it. If we look at the economic data first, I wanted to start more broadly with real gross domestic product. This is broken down into consumer spending plus investment plus government spending and then net exports minus imports and adjusted for the cost of inflation. This measures the overall health of the U.S. economy as the sum total of all the goods and services produced. For the most part, consumer spending accounts for around 60 to 70% of real GDP. From the most recent economic data release on February 20th, 2026, real GDP slowed to 1.4% growth for Q4 of 2025. This is lower than economists were expecting. And if we look at the reasons for this, the Bureau of Economic Analysis says it is because consumer spending is decelerating along with decreased exports. So if the consumer is shaky, you can expect corporate revenues or margins to be affected and in turn stock prices to fall. Now this can have a disproportionate effect on different segments of the market depending on the reasons for the decrease in spending. If we then look at the inflationary data, we can see an uptick in personal consumption expenditures sitting at 2.9%. The reason the government breaks out PCE and PCE core is because food and energy are more susceptible to supply-side shocks that don't have anything to do with the U.S. economy and don't necessarily accurately measure the stability of prices in the U.S. For example, if there's a war in the Middle East and the Strait of Hormuz is closed, this could affect oil prices and energy prices, but doesn't necessarily accurately represent the health of the U.S. economy. PCE is the economic indicator that the Fed likes to use to track inflation, measuring how much each consumer is spending on goods and services each month. Now, the Federal Reserve has a dual mandate for stable prices and full employment. This can sound kind of ambiguous, and the target rates for employment and inflation have changed over time. But in recent history, this has been a 2% target rate for the inflation and unemployment rate. In general, these two measures, the unemployment rate and the inflation rate, are inverse. This is because of the Phillips Curve, an economic concept that shows the relationship between the unemployment rate and inflation rate. The Fed uses interest rates to try to control this relationship. Lowering rates will increase borrowing and investment throughout the economy and in turn increase hiring and consumer spending, which can increase the prices of goods and services, which can cause higher levels of inflation. Increasing interest rates makes borrowing and investment more costly, thus decreasing the rate at which new jobs are created, but also slows demand, which will keep prices lower. If we look at the personal disposable income, you can see the consumers are saving less and less. I don't want to make a big deal out of this, but decreasing personal savings, decelerating consumer spending, and slightly increasing prices is not a healthy trajectory for the economy. Combine this with a high unemployment rate of 4.3%, which the Fed is more worried about than inflation, I think we have reason as investors and consumers to be a little more cautious in our expectations for 2026. Being worried about unemployment would cause the Fed to cut rates, which they have done over 2025. But in general, over time, as the natural rate of interest rates drop, the Fed has less control over the economy by means of monetary policy. We've seen the Fed cut short-term rates down closer to zero, but this is essentially tinkering around the edges and has had little effect on longer-term bond rates and 30-year mortgage rates, which affect GDP at a larger scale than the shorter-term federal funds rate. I hope that keeping rates steady or cutting will keep inflation around 3%, and unemployment can come down as well, but that remains to be seen. With an uptick in inflation and an uptick in unemployment, this creates a stagflationary environment, which can be hard to get out of without some sort of slowdown in the economy. I think we have seen the market more cautious and reactionary to news since the new year started, partly because of this, as well as the entire growth of our GDP is essentially leaning on AI spend. If you divided AI spend by the hyperscalers by total GDP, the amount of money being pumped into the economy by the hyperscalers makes up around the same percentage of real GDP growth that is being forecasted for 2026. The economy is not growing outside of this spend, and the returns on hundreds of billions of dollars of AI spend remains to be seen. This is why the market is worried about AI Capex. Whether the businesses you invest in are directly affected by the AI spend or not, a broader economic recession will affect all segments of the market. If we look at the actual job numbers themselves, so a lot of economic indicators are lagging because this is how you gather data on the economy. You can see in a release from February 26th this year by the Bureau of Labor Statistics, which is adjusting job numbers from last year. You can see in between March and June, job losses were around 7.9 million, and over the same period, jobs created were only 7.6 million. So you have less jobs being created than jobs that are just being closed out of existence. If we continue with consumer sentiment, the University of Michigan does the Consumer Sentiment Index, which has historically provided an accurate representation of forward-looking consumer sentiment. The index is derived from 5 primary questions covering personal finance compared to a year ago, expected financial situation in 1 year, expected business conditions for the next year, and business conditions for the next 5 years. While this is soft data as opposed to the hard data we just looked at, you can see that over the last year, consumer sentiment has come down, showing that consumers are more pessimistic about the economic conditions we're looking at. And this was before the war in Iran started, which will see macroeconomic impact depending on how long the war rages on. But because consumer spending makes up such a large portion of GDP, the sentiment or attitude of consumers about their financial well-being and spending and the future of both is very important in gauging the health of the economy. When consumers are uncertain or worried about what lies ahead, they tend to save money and make fewer discretionary purchases. Negative sentiment weakens demand for goods and services, which impacts corporate investment, flows into the stock market, and employment opportunities. And as you saw with the savings rate, this is also declining. Throw in that we have a new Fed chair who is seen as relatively hawkish in terms of the policy he wants to implement, as well as the Iranian war. There's just a lot of uncertainty looking forward. In general, a stock's multiple will trade relative to the company's margins and growth rates, and a mix of what those look like. With changes in consumer spending and sentiment, as well as the uncertainty of what AI will do to margins in different segments of the market, especially in tech, you see a drawdown in a lot of stock prices. And I think rightfully so. I generally think AI will be a reality-changing technology for much of the world as we know it today. However, the rate at which AI will change industries and businesses and how it will affect profitability remains to be seen. The entire economy is hinging on this AI spend working in terms of return on investment for these large AI firms. So looking at the rate at which AI is tangibly affecting businesses is extremely important when thinking about investing in a company. This brings us to the next part of the video, which is looking at some of the data surrounding the adoption of AI. So this data is from Kai Wu, who is the founder and chief investment officer of Sparkline Capital. I want to give credit where credit's due, who in their words are an investment management firm applying state-of-the-art machine learning and computing to uncover alpha in large unstructured data set. And that's exactly what a lot of these graphs are. What his firm has done is build a large language model that scoured and analyzed thousands of companies' data, including earnings calls, transcripts, quarterly and annual reports, specifically looking for data points that indicate how the company is using AI, to what extent AI is affecting their tangible business operations. The first graph is looking at the 5 stages that improvements in technology makes its way out through the economy. So this trend that you see is true for all technological revolutions, from the railroads, electricity, to all the way to the internet. The first stage is always infrastructure. This is the data center spend we've seen from the big technology companies. The next stage is whether consumers are actually willing to buy and use this technology. This is where you get the early adopters. After them is the early majority, late majority, and laggards. This is the rate at which companies are adopting AI. We're at the point where we figured out who's going to have enough capital to buy the infrastructure, and we're beginning to see if the demand will align with the amount of CapEx spend that is being spent on this infrastructure. In order to measure these gains, the data has been broken down into 3 different categories. Through the LLM, this is how they ranked companies based on how AI is driving economic gains. This helps to see more clearly if there is any fluff from management in earnings calls that they may be giving on AI. It reduces the impact of AI to the visibly measurable key performance indicators that businesses show relative to the segment they're in. So they broke down the measurables into different categories that show us where the most of AI-driven return on investment has been distributed. This shows that the majority of AI gains has been driven by revenue growth, productivity gains, and cost savings. So when we look at the companies who have fundamentally already benefited from AI, most are seeing gains in these 3 areas. Then compiling all that data, they calculated the average percentage of outperformance relative to the market. As you can see, companies that have changes in fundamentals due to explicit AI-driven ROI have outperformed by 5.2%, and companies that have seen economic gains as a result of adopting AI are outperforming by 4.8%. And we can see that there is still a percentage of companies who are using AI but haven't seen any actual gains. I would stay away from these companies because the level of ambiguity that management can say when they're talking about how AI is affecting their businesses is extremely high at this point. But if we look at the AI-driven return on investment by category, the graph is broken down into the same 3 sections as before, but on the x-axis, there is the rate of adoption for companies that have actually built AI infrastructure, companies who are early adopters, who may have invested in AI but not in infrastructure, and companies who are late or lagging in AI adoption. What you can see is companies that are early adopters are seeing higher AI-driven economic gains and explicit AI-driven return on investment. I believe these are the best type of companies to look for right now. Companies that are tangibly benefiting from the technology, but not partaking in the large infrastructure build-out that is in the form of the large capital expenditure numbers from the hyperscalers that has uncertain payoff. If we look at the scatter plot that measures AI adoption on the x-axis and valuation on the y-axis, this shows that there isn't necessarily any correlation in valuation between companies that have seen AI-driven economic gains and companies that are lagging in AI adoption. This could be the area for opportunity for us. The market has not rewarded early adopters of AI that have seen economic gains without infrastructure investment relative to companies or industries that are lagging in AI adoption, which is not what we see with companies that have invested in AI infrastructure, which are already seeing more premium valuations. You can see that this scatter plot is a cloud. There's no correlation between early AI adoption and valuation. So there should be some companies in here that have tangibly benefited from this technological revolution who have not yet seen increases in their share price. The last graph I wanted to look at is valuation by category. It's glaringly obvious that AI infrastructure stocks have the most premium valuations, despite the uncertainty of the return on investment. With our whole economy hinging on the ROI of the Capex data center spend, this seems like it could lend itself to a more volatile market this year. If there are companies that have seen tangible return on investment from AI-driven gains without having to partake in the massive Capex spend, that seems like a less risky investment to me. So what have I done with my portfolio as a result of some of this data? Well, one of the categories or industries that has been a proven beneficiary of AI as a technology are advertising businesses. AI has been shown to improve things like ad targeting and efficiency for ad companies, with companies that make the majority of their revenue from advertising already reporting significant increases in economic gains. Part of the reason that I decided to open a position in Reddit is because I think they firmly sit in the AI early adoption category, without having to take on large infrastructure investment for AI to increase their business. They are positioned to continually be uplifted by AI due to their business model that has roughly 90% gross margins and growing operating margins. Now, I generally don't sell companies unless there is a better opportunity in the market, but I believe this was the case with Reddit, and so I decided to sell out of my smaller positions of MasterCard and Netflix, as well as trim my Google position in order to do a larger lump sum investment into Reddit. Now, I don't think that MasterCard or Netflix are bad companies by any stretch of the imagination, but they were generally smaller positions, and I was just waiting to build them out when I discovered Reddit and the opportunity that I think is present at the current share price. This isn't a full thesis or valuation on Reddit. I'll link a dedicated video to that in the description, but the portfolio has maintained value for me as we've had some uncertainty, which I'm overall content with. And just briefly, some areas that I would stay away from due to the data and economic situation. I would for sure stay away from companies that are consumer discretionary. These are companies that sell goods and services that are wants but not necessarily needs. If there is any decrease in total consumer spending as a result of increases in inflation due to the macroeconomic or geopolitical situation, these would be one of the areas of the market that gets hit hard. I would also stay away from the real estate sector. Generally, this sector has stocks that are tied to housing prices, which can be greatly affected by interest rate changes and any other changes in the housing market. Any decrease in housing prices or increase in factors that can negatively affect housing supply, for example, inflation or tariffs, will hit this sector hard. With upticking unemployment, upticking inflation, increasing producer costs, and decelerating consumer spending and savings, I don't see a clear path to increases in stock prices or earnings for these companies right now. Let me know in the comments what you've been doing with your portfolio as a result of all the macroeconomic and geopolitical news that have been going on recently. Subscribe to the channel and like the video if you like transparent investment and economic videos like this. I appreciate you watching.